So hello everyone, welcome to the second session of the Private Equity Foundation module by Cyril de Maria. I had sent you already the recording of yesterday's session, so if you had time to review your notes and the recording as well, I think we can start with your questions. Welcome, Cyril.
Thank you very much, Evie. It's a very special day, everyone. It's Evie's birthday, so if you have 5 minutes, drop her a line and say happy birthday. Yes, meanwhile, we can start with the Q&A. If you have any question, you can either open your mic and ask it, or drop a line on the chat. No questions. It was very intense. The first session is always very intense because there are a lot of concepts to put on the table. Today it will be probably deeper but less fast in the sense that I will try as much as I can to give you more background on these three dimensions of private market investing. So of course, the suspense is what is the third one, right? We talked about risk, we talked about returns. Another question is, what's the other one? Suspense. We will start with the answer immediately after the Q&A. Any question? Of course, we can do it also at the end of this session in case the questions would emerge. Yesterday we saw this, and then how do you connect that with today, or can you come back to this concept? For the sake of time, then I will start. As you know, the video is recorded, and Evie is the one who will contact you with today's recording, and then we can follow up with the next questions also tomorrow and the next day. So let's start. So you already know me, I will skip this one. Today it's 5 sections, and surprise, surprise, the third dimension is liquidity. So we will start with that. I killed the mystery already. It's more of a Columbo episode, less of a Hitchcock, right? So it's liquidity, returns, and then risks. And then we will talk about benchmarking, which is a key factor. We talked about the vintage year yesterday and the importance of comparing the fund with its peer group. So we will dig into that. And as usual, to try to prep up the Q&A, I have current debates about line of credits, which are also called equity bridge financing, and the cost of unused capital. Let's start with liquidity. I think there is a bit of misconceptions here. You will hear a lot about the fact that, for example, private equity doesn't create value. For some authors, if you look at recent publications in the journal of the CFA, for example, there was a famous paper who said, in which the author said, if you buy small caps and you leverage it up and you wait, you will have the same performance than in leverage buyout, for example. And they say, so the only excess performance that you would record between private equity and index of listed products is essentially an illiquidity premium. The problem is that this reasoning has multiple flaws. The first one is that it's very easy to compare after things happen. The fact that, yes, the LBO has been targeting this and that sector. So if I slice and dice the listed stocks and then I try to gather them, then obviously I will get some insights that I wouldn't have before I started to invest in LBO. So backtesting already, we all know that it's very challenging to do it properly and to avoid any bias. The other thing is that the leverage, yes, contributes to the performance of LBO, but it doesn't in venture, for example, or in growth. So it's very easy to say private equity is just a matter of leveraging up and waiting, but it's not totally true because you cannot do that with venture and growth. And even if you consider buyout, as I said yesterday, statistically, it's shown that only 1/3 of the performance comes actually from the tax and the financial leverages. So it's not really convincing. That's why I try as much as I can to get out of the debate about liquidity and say, look, we are in the non-listed world. It's a dimension of investment. And actually, we can quantify that. That's going to be my next slide. And we should try to isolate how much we get rewarded for waiting. That must be part of the performance, but actually it's very difficult to do. And how much comes from the fact that the fund manager is able to select the right sectors, the right companies within these sectors, to have the right strategy to grow the value of the assets, and then ultimately to sell it in the appropriate way. That's the value creation, and that's something that theoretically should create an outperformance versus the listed stocks. So in that sense, talking about an illiquidity risk, and you will hear that a lot from our friends in hedge funds or listed equities or listed bonds, they usually say, oh, there is an illiquidity risk, but it's not a risk. We're in non-listed world, so it's not a risk because by construction, it's not listed. It's not tradable easily. So it's a bit weird to talk about the risk, which is not a risk because it's a dimension of investment. And so the tradability of assets is very limited in our world, and it doesn't shift over time. It depends on who wants to transact on what, okay? And likewise, then, if there is no illiquidity risk, it's very difficult to quantify the illiquidity premium because it's always about risk and return, as we know. And so, in that sense, I think it paralyzes our brain, this notion of illiquidity premium. So I try to stay away from it. Now, why do we still talk about it? Well, because clients discuss that. And for example, if you talk to a pension fund manager or a high net worth individual or a family office manager, they would say, well, you know, we commit to funds, we're stuck for 10 years and or 13, maybe 8 if it's direct lending. We are not really comfortable about that, or we think that's too risky. And so what I did is that I looked at the reality, and the reality is that, first of all, we shouldn't confuse the fact that the fund itself is created for a certain period of time and the actual time during which you're invested. That's a very big difference because, as we said yesterday, the fund calls the capital as needed when the fund manager wants to do an investment on behalf of the fund. And then as soon as it's possible, under very good terms, of course, the fund manager will sell the asset and then the cash will go back to the investors. And if you remember the J-curve graph yesterday, there were distributions in year 4, 5, 6, 7. So you don't have to wait the end of the 10 years of a typical private equity fund to get your cash. So the fund lifespan is like printed very heavily in the mind of fund investors, but it diverges from the actual time during which we're invested, which we will call investment duration. It's a proxy, but it's a good term, and we will use it for the sake of simplicity. So what are the actual durations? Well, I did a graph for a client actually some time ago, but it doesn't change a lot over time. And the data anyway changes every quarter. And this aggregates decades of data, okay? And what I discovered is that actually, if you cannot wait 3 years, you shouldn't be in private market because the shortest duration that you have, which is here, this red cross here, which is US energy funds. Surprisingly, this is the shortest duration. It's a little bit above 3 years. It's around 3.2 years on average over a very long period of time, okay? And then you have, of course, US growth fund, which is the bubble, the red bubble here. And then you have other strategies, rest of the world energy. There should be secondaries, which are coming fairly fast. Ah, yeah, that's the yellow triangle here. So these strategies are potentially providing you with your cash back plus hopefully the performance within 3 to 4 years, let's call it like this. And then you see that actually some strategies have longer durations than others, and others are actually performing better than others. Now, if there was a relationship between duration as a risk and performance, you would have a kind of cloud of dots like this, and then there would be a trend line, which eventually should emerge, right? And so the dots should be gathering around this trend line. I tried to draw a trend line, but it's basically inconclusive, and the correlation between the multiple and the duration, what we call the R square in statistics, is actually non-conclusive. It's around 0 point something. And to have a conclusive R square, it should be heavily negative or heavily positive. So above 0.6 or below minus 0.6, okay? To have a correlation or an anti-correlation. Here, there is no such thing. So it shows that the performance is independent from the duration. It's independent in the sense that it's not because you increase the duration that you lose performance or you make more, okay? You need, for example, around 7 to 8 years with timber and infra. If you don't have this time, then there is no point to make the investment. You cannot make shorter investments in trees. Trees won't grow faster. It's just, that's how it is. And it's the same for our infrastructure. Now, if we want to be precise then, and we want to talk about a liquidity risk, what would it be? Let's take an example on this graph. Actually, the actual liquidity risk, if we really want to talk about it, would be the variation around this average, okay? So let's take an easy example. You have US VC funds, okay? US venture capital funds, that's the red diamond here. The red diamond is very weird because normally you would assume that it takes longer to grow startups than, for example, to invest in mature companies, which is US buyout funds, that's the red square. But for some reason, the diamond is shorter, right? Why? Because heavily represented in the sample are the vintage years 96, 7, 8, 9, and 2000. And at that time, the average duration of investment was below 3 years. At a certain stage, it was even 1.5 years. So basically, you would get in and immediately get out because the market was a bit bubbly, let's call it like this. Now, if you look at this, I should use my laser pointer. If you look at this diamond and you start to look at the extreme of durations, you will see that it can fall to a certain extent here for the bubble years. And then later on, you might have an extreme duration extension because the post-bubble years were very challenging. So you would have to keep your startups much longer, okay? Now, does it mean that the multiple is going to change? Actually, I did the exercise and no, actually, when you have a lower, let's say, exposure, it doesn't mean that you had a higher multiple. Once again, there is no connection between duration and performance. So it's very interesting because if you start to think about the consequences of this graph, it opens a very wide field of thoughts. One of them is what we call portfolio construction, which is one of the sessions we will have this week. But if you start to say, well, you know, this investor cannot wait more than X years before getting back the capital because of the age of the beneficiary owner or because of their liabilities, then it means that you have your cutoff date, okay? And then if you assume that the liquidity risk is the variation around this midpoint, then you can start to look at historically how much did it diverge and how would you compensate such a risk? Maybe by adding something which has less variation around it, or which, for example, has a shorter duration when the other one has a longer one, even though technically it doesn't really work like this and it's very challenging, but you can somehow use this data to start to build your portfolio and look at what are your constraints and how do you match within these constraints. And as I said, if you cannot wait 3 to 4 years on average, then you shouldn't be in private markets at all. That's just the nature of it. And we said yesterday that listed private equity doesn't really work. So at least not in the sense that we wanted to explore it. It might work for some investors, but in general, the discount on the net asset value and the fact that it's very sensitive to market conditions means that you cannot really replace this question about duration with something which is short, very short duration, because if it's liquid or listed, let's call it like this, you could argue that you eliminate a duration question. But the fact is that you have a discrepancy between the underlying duration, because ultimately this is a referential, and the liquidity of or the tradability or the let's say exchange of the listed structure. This mismatch is very difficult to handle for a lot of people, and also overall the investors factor it in when they price the listed private equity structures. But nevertheless, this is the third dimension, and that's why I wanted to start with it, because it's very unusual. And if you look at the asset allocation models, such as the capital allocation, the standard framework, basically Markowitz, etc. Markowitz himself says it's just for listed assets. You have listed bonds, listed stocks, and boom, you build portfolios, you're efficient frontier, etc. The problem is that when you start to put private markets there, you introduce this Z axis, right? You have X, Y, and you need Z. And the problem is that nobody so far has managed to explore that in a systematic way. And it's actually very challenging. I tried to look into it with my latest book, but I was stopped early, because you need to develop a full body of academic literature and heavy mathematics. And honestly, it's beyond the work of just one individual. You would need multiple individuals looking into that. Now, if we look at returns then, which is a much more common perspective and which is what's driving clients' attention, right? Well, not surprisingly, returns are dispatched around, let's say, 3 indicators. One is the internal rate of return. I will go into that. I have a slide at least illustrating and one explaining. The problem with the IRR is that it's a bit challenging to interpret. The IRR was developed for comparing simple investment projects. I don't know, Allsim, ABB, British Telecom, and you want to compare project A and project B. They don't necessarily have the same duration, the same starting point, but you still need to compare them. Then the IRR is really well suited because it's a simple environment. You can calibrate all the other variables which go into the formula, and then you get a clear perspective. The problem with the IRR is that with complex subjects like funds, which have multiple investments, the timing of the cash flows introduces distortions. So the IRR, for example, is very sensitive to early cash flows. It overweights them. And of course, some people love it because they say time has value. So it's normal that, cash flows which come later are underrepresented in the overall performance. The problem is that, yes, in a way, but no if it leads you to the wrong conclusion. Let's take a quick example. You have fund A and you have fund B. Fund A makes 2 investments. Let's call the first one good investment and the second investment so-so investment, okay? Fund B does exactly the same 2, but in the reverse order. First so-so and then good. Technically, the 2 funds return the same capital, okay? Because they have invested with the same amount in the same project. And in my theoretical example, they have the same cost structure, etc. So the multiple of investment that I will discuss in a second is exactly the same. And it's computed how? How much do I get back? Net of any fees and costs, divided by how much did I put in. Okay, so it's usually expressed as a multiple of 1. So if it's less than 1, we saw it yesterday with my graph with the bars, the blue bars, the yellow bars, and the green bars. So if it's less than 1, you lost money, and if it's above 1, you made money, right? So far, so good. So fund A and B have exactly the same multiple, but A will make you think that you're richer than B. Why? The problem with the IRR formula is not only that it overweights the early cash flows, but it assumes implicitly that you can reinvest the cash immediately at the same level of return. And this you can correct in your Excel, or if you want to do it manually, which I don't encourage you to do because it's fairly cumbersome. But in Excel, you can correct that. You can correct the reinvestment rate and set it up to 0, etc. So it's not that the formula is badly designed, certainly not, but the assumptions have to be controlled. And the other thing that we have is that we want to compare funds with a peer group. But if the peer group, which you have no control on, was computing the IRR formula with a normal reinvestment rate, which is the implicit automatic one, and you correct it by setting a 0% reinvestment rate, then suddenly you break the comparison framework. So the IRR still today is discussed. It's an easy concept to understand. It's annualized, as I explained yesterday, with my 3 years, 2 months, 1 day. So we have a question from Alan. Are there any more sophisticated or alternative measurements being developed? I will go into the public market equivalent in a second, which is one, yes, but actually, to my knowledge, there is no real alternative to the IRR and the multiple of investment. It's not that people are adverse or lazy or they don't want to explore. It's just that it's not that easy to develop new methods, unfortunately. Knowing that it has to be something that people understand. I will take another example briefly just to complement my answer to Alan's question. There is something which is called the modified IRR, MIR. And if you use it in Excel, the MIR, for example, would tell you that fund A and B are the same performance because the modified IRR doesn't overweight the early cash flows. It considers that all the cash flows start at the same time. So A and B, regardless if they did so first or after, would have the same MIR, right? So that sounds great. And technically it is great. It avoids a bias. The problem with the MIR is that it's very difficult to understand first. And second, the variation of performance between different instruments are 3 or 4 digits after the comma. The MIR doesn't vary a lot, and it doesn't, you know, the IRR magnifies basically the amplitude of performance. You can be at 15%, 18, 20, 25. The MIR will tell you that you are at 3 all along, and then if you really have to look, you would have to say it's 3.1234 versus 3.123, maybe 5 or 6 or 7. So it's very difficult to interpret the MIR, okay? Even though it could be an alternative and it corrects some biases and the tool exists already for quite some time. The multiple of investment then is an interesting perspective because it's easy to read. Everybody can calculate it. If you explain that to a 5-year-old, I think you would understand more, maybe 6 or 7, but you're basically when you're in little school, that's the first thing you start to understand before percentages and annual performance and all of that, right? The problem is that the multiple of invested capital talks to us, but it doesn't talk to the rest of the financial universe. If you go to your colleagues active in the listed world, they would tell you, what's that a multiple? I don't understand. The S&P grew last year by X%. So tell me what's comparable. When I was working at the bank, I had always this big debate because they wanted annual performance. I don't have that. I have an IRR and you cannot really compare it. And I said, can we compute a multiple? And they say, but we are not going to change our old framework just for you. And the investors, our clients, don't understand the concept of multiple for their day-to-day activity. They're not interested by that. What they're interested by is the growth over a year or over 6 months of the value of their portfolio. So the multiple is nice. It's, as we will see, it has a lot of advantages. The problem is that it pushes us to stay confined in our universe. And now comes the third one, which is called the public market equivalent. The public market equivalent is quite interesting because basically it supports cross-asset comparisons. It's not the magic solution, unfortunately, but what's the design behind the public market equivalent is you take the cash flow of a fund, okay, the cash flow pattern, so drawdowns, capital calls, and then distributions. And when you do this, virtually, you buy and sell an index of listed assets. And the idea is that at the end of this exercise, you would have the same duration, the same basis of comparison, the same pattern. And so you could compare at least the IRR and the multiple of your fund with the equivalent IRR and multiple of the index. And we really compare apples with apples. Now, the public market equivalent is a fairly recent method. It has been very difficult to emerge because there were some flaws. And notably, one of the flaws of the initial public market equivalent method is that there was a problem with the NAV. And there was another problem, which is that when a fund distributes and you're an investor, you will know how much of this is refunding the fund for the capital that you put and how much is the performance, okay? So the profit. But if you compare your fund with the peer group, when you extract data from the databases, you have capital calls distributions, but the distributions are never given to you as a breakdown with what do we refund and how much is the performance. And so to do a public market equivalent, you need that because otherwise the risk is that you never know how much of the index you should sell when there is a distribution, basically. Okay, especially if you want to compare a bunch of funds, a peer group, basically. So individually, you can analyze, and it's not too difficult because you have the details of the cash flows. But as soon as it's aggregated and you're not in control of the information, the PME is much more difficult. So the more recent methods actually handled that. They basically found a way to reintegrate the net asset value in the analysis and basically try to proxy what's happening in a group of funds or in a fund where you don't have the details of the cash flow with the listed index. But so the PME is probably one additional metric of performance and a useful one because it creates a bridge between other asset classes and private markets. Nevertheless, beyond these quantitative aspects that we're going to come back to in a second, what you will hear is that qualitative analysis matters a lot. Because often fund managers will say, oh, my net IRR is X and my multiple is Y. And the question is, how did you make the performance? Most of the fund investors are interested by the past, but they're even more interested about the future. And when they need to decide, for example, to reinvest in a fund, to reinvest with a fund manager in the next generation of funds, what they want to know is how much of the past performance can be replicated with a certain level of confidence. Of course, past performance is no indication of future ones. But in our asset class, you will see that actually it's not totally unheard of that if you're a very good fund manager, there is a high likelihood that you're going to remain so. That's called the persistence of performance, which has been documented. And at the same time, that if you did an investment strategy which works and the macro dimensions and the structural dimensions of your market didn't change, then theoretically the accumulated experience should help you to try at least to reproduce some or all of this performance going forward. And so to do that, you will see that fund investors often ask a lot of questions. The due diligence package, the data room, whatever you want to call it, it's here to provide this qualitative element. Let's take a quick example. Often you will see that the dispersion of returns in a portfolio of venture capital funds, in the portfolio of a venture capital fund can be fairly high. And that's related to the statistics that I gave yesterday, which is 50% of the fund will go to the bin and the rest will basically be so-so or very well performing. In buyout, it's not supposed to be like this. there is much more coherence in the performance. And so around the, let's say, reference multiple, you will see some deals which do better, sometimes very well. And there are some which do a bit less, and sometimes, but very, very unusually, as I said, 3 to 5% of the time, you would have a crash, okay, in the portfolio. But it's very unlikely that you would have the same dispersion, than in venture. And if it happens, then of course it should trigger a lot of questions. For example, I've seen some LBO funds where they had multiples of 8, or today there was one which was announced in the news where they were even above 10. It's great. I mean, if you're an investor in the fund, this is like a good surprise. But then the immediate question after is, was it planned? When they sold you the fund, did they tell you that they were targeting unusually high multiples? If not, then you have to document what happened, how did they generate that? Was it an accident? Was it luck? Because luck is not predictable. And so it's not because they had this great performance once in a fund that you can expect it in the next one. And actually, you will see that some fund investors eliminate some outliers to recompute the track record of the fund manager, saying this deal was pure luck, or let's call it like this, a mix of luck and a lot of hard work. But the luck just is not predictable, and we don't want to count on that. So that's why you would look at how the portfolio was built, and then within that, and that's what I wrote here for LBO funds, for example, you will try to attribute the performance of each deal to specific levers, which are maybe top line growth. So sale increase, is it through M&A, is it organic, is it a mix of the two, or is it better efficiency? Did you reshuffle the asset, etc.? And they want to attribute the performance because here again, what they want to understand is the performance replicable? And that's why the qualitative assessment is so important. And it didn't change over time. I know that we talk about data all the time. We talk about richer, more frequent data, but actually our job didn't change for a long time, which is understanding where does the performance come from and how much can be reproduced going forward. So that's why, even though we're going to focus on quantitative elements now, we shouldn't forget that it's just one part of the analysis. And then beyond that, there is heavy work to be done on the analysis qualitatively of the portfolios. Now, one of the big challenge is the time lag. When I know what happened, usually multiple years have been gone, basically. Because of the slide I showed you about the durations, if you assume that in most cases, the investments in private markets are situated between 3 to 6 years of duration, then it means that when you start to know what's happening, it's been already one business cycle, which is gone. And so that's a bit of a problem, because of course you could look at what's currently in portfolios, but it's not finished yet. You don't know the full story. So you try to assess the quality of a filmmaker by looking at the first half hour or 45 minutes of the movie, but you didn't see the full movie. So it's very challenging to forge an opinion about the quality of the filmmaking then. And that's a big problem. Another example is my clients want to benchmark, for example, their performance, either with individual funds or a portfolio of funds, or even at a more aggregated level. And the problem is that today I can only have data, actually it's been published today. For example, with eFront, their database has been updated today as for Q4 2020. But with Cambridge, if I'm not mistaken, Cambridge Associates, I'm still working with data which dates back Q3 2020. And it's not to blame them. It's very challenging to collect the data, check it, make sure that everything is coherent, and you still have to wait for the data coming from the fund managers, and they want to do a good job. So the delays are accumulating, and the best you can get is at least 1 quarter, maybe 2 of delays before you know the data with a certain level of certainty. And so that's making our life quite challenging. This time lag, unfortunately, is going to remain for a while. And there are some attempts of building models which are trying to bridge this time lag to try to make accurate assessment as of today, or even to make some predictions, but it's very, very challenging. So let's have a quick look at how do we extract information and what do we actually get. This is an old table. I rely on public information, of course, to do this kind of trainings, but honestly, it doesn't matter, because here what matters to us is not the figures themselves, but how do we read them. So this is a table coming from Preqin, and it's looking at buyouts globally, and the picture has been taken as of June 30, 2013. Okay. So what do we have? The first thing that we have is the vintage year. So the year during which the fund was created. There is a bit of debate about how do you assess the vintage year. Is it the legal creation? Is it the first capital call, which is the reference? Is it the first investment? There are different philosophies, and nobody is right, nobody is wrong. Actually, any kind of data point that I've been mentioning could be relevant. The only thing you have to check when you look at this data is what's the philosophy of the database provider, to make sure that you don't misinterpret the information. Now you might argue, why do we care? Well, if your fund is created in a year and the first investment happens in the next year, then there could be a debate about which vintage year does it belong to, and what's the peer group. And as we will see, from one year to the other, for example, here 2007 to 2008, the performance, the aggregated performance of the peer group can change substantially. Here, you could be, for example, comparing yourself with a median performance of 135 times your money, and if you drop next year, it could be 125 times your money. You might say it's not a big difference, maybe, but first of all, the funds are not finished because we're in 2013, so it's still very much in the making. And what matters is not the median, it's how your funds compare to this median. And often what we do is that when we take a peer group, we slice and dice it in tranches, like the top quartile, which is the top 25%, the second block of 25%, which is second quartile, the third and the fourth. But sometimes we even slice it in deciles, so top 10%, and then the next 10%, etc. That assumes, of course, that the sample size is big enough to support a decile analysis. Here, you just have 8 funds in sample in 1991. So already doing a quartile analysis is a bit challenging, but a decile is impossible because you simply don't have 10 funds. So that's also limiting us, of course, in terms of information and what we can extract from it. But if you look at older funds, which are theoretically finished, like 98 or before, you will see that sometime from one year to the other, you can see very big discrepancies in the median performance. So in 93, in buyout, which were very good conditions to invest, just there was the first Gulf War, so markets were in turmoil, a lot of economic shocks, and LBO likes changes and disruptions because that's where you can really start to negotiate good deals and then really reshape assets and make them much more valuable. So you see, in 93, you could have a 2.15 times your money if you could buy the market. Well, if the median performance would have been. But if you compare yourself with a peer group in 94, then suddenly drops to 189, and then the year after 167, and then 148. So the attribution of a fund to a vintage year, of course, will make a big difference because you might lower or increase the benchmark, the hurdle that you need to clear to appear as a very successful fund manager. And there might be some temptation sometimes to game the peer group and to try to be qualified as a vintage year where the average performance of your peer group is lower so that you could do better, okay? So these are the vintage years, and then I already talked about the sample size. You see that at best here we get 95 funds, and at worst it can go as low as 8. So comparing yourself with a peer group of 8 funds, that's a bit of a challenge. Our friends in statistics would say it's not relevant as a sample size, so it's too noisy, not reliable enough, but that's what we have to deal with, unfortunately. And as I said, there is no Bloomberg of private equity in our world. So that's the best we can get from Preqin. Maybe other database providers would have better or even worse sample sizes. And that's why sometimes it's good to compare a bit the database providers, but beyond the number of funds which are captured, what you have to look is the distribution along the line. So maybe a database provider which has less funds but is more homogeneous in terms of vintage years is more useful for the analysis you want to do. Okay. Then they provide you with statistics of activity. So they look at a virtual fund, which is the median. The median is a statistical point, but it doesn't mean that this fund exists. It's not an average fund, it's a median. And so they take the two extremes and they look at in between, where does it fall? Okay, exactly in between the two extremes, at the middle of the two extremes. And so here, for example, you see that the capital has been called to a certain extent for the very recent funds. Since we're in June 2013, only 8.5% of the vintage years 2013 have been used so far. And you see that it increases fairly fast. And then after a while, it stabilizes and it increases very slowly. Why? Because after 5 years, your fund is mostly invested in buyout. There is no reinvestment in your portfolio company. So what's left between your capital called cumulatively and the fund size is the space for the cost and the management fees. Okay. And so that's why in these years here, you see that actually we're very close to 100%. Okay. And then you see that sometimes even with the old funds, we didn't use overall all the cash, probably because there were some reserves which have not been used for doing some work, basically. So we didn't exhausted the full fund size. Sometimes you will see that some funds use more than 100% of their fund size, which can look very weird. I did that in my second fund. When you sell a portfolio company early, in some fund regulations, they say, well, if you're still in the investment period, you can reuse this capital to be reinvested. And that's why you could end up with a capital called, which is above 100%. Okay. And is there a limit to that? Yeah, normally the reinvestment is compensating the management fees and the cost. So I think theoretically it shouldn't go above 120% unless you're very successful and you could recycle a lot of capital very early, but it's very, very unusual. Okay. Then the second thing that you get is how much has been given back to the fund investors. But this is not computed here as a percentage of the fund size. It's computed as a percentage of how much was used. What we call the capital called is also called the paid in. Okay. And so here, when you in 2005, you read that the distributed is almost 87%. It's 87% of the 97.3% which have been used, not of the fund size. Sometimes we can compute a distributed to committed capital, the committed capital being the fund size. Sometimes it's computed, but often we refer to how much we used. And here, what you see is that we can also compute what's left in the fund, what we call the residual value, which is the equivalent of the net asset value that I was talking about yesterday. We sometimes have the same concept with multiple names in private markets. Just like yesterday, we had one name used for multiple concepts, so it can be misleading. And I admit sometimes it's a bit confusing, but nevertheless, we can compute a ratio which is what's left in the fund versus how much is used. And here, very interestingly, you see that there is nothing given back to investors. It's normal. We are just 6 months into the vintage year 2013, but the residual value is only 80% of what was effectively paid in. So why? Because of the management fees. The management fees are a cost. They don't appear in the residual, the net asset value of the fund. So that's why it looks as if the fund lost money. It didn't really, or it did if you consider that the cost and the management fees are a loss. But then you see that sooner or later, the value catches up, and then ultimately it starts to appear as more than what you actually invested. Why? Because of the valuation rules I was referring to yesterday, which forces you to market your portfolio. It's easy with buyout because you have sales, you have often an EBITDA or an EBIT which is positive, and so you can use that to mark your portfolio to market. So compare it with listed stocks. When you have negative EBITDA or negative cash flows, like in distressed debt or venture, it's much more difficult to put a value on your portfolio companies. And so that's why the residual value might not change in the same way than in buyout or growth capital. Now, as you can see, there is a very interesting phenomenon here. The more recent the fund is, the less it has distributed. Of course, that's quite logical. It takes these 3 to 5 years to actually grow the assets and then sell them. And then, of course, as the fund matures, the residual value goes down, actually, to the point that at a certain stage, it's finished. So here in 98, all the 52 funds are fully realized, in the sense that they don't have any activity anymore. In 99, some of these funds might still be active. That's why you have the 1.2% here. And then you see that after that, it's a mix of what's sold and what's still in portfolio. The inflection point is in our example here between 2005 and 2006. 2005 is more realized than still active. 2006 is still more active and effectively realized. Okay. So this is more to measure where the funds are, how is their activity, and how mature they are. Okay. So it's a good metric to look at this breakdown, and it's quite useful to still intellectually know where we are. And then after that, you have the performance metrics. Okay. So there is a multiple. So theoretically, if you look at this multiple here, and the multiple is a multiple of invested capital, total value to paid in. So that's the sum of DPI and RVPI. So theoretically, the median here should be essentially the DPI plus the RVPI divided by 100. And so here it works. Sometimes, for some reason, it doesn't work. But if you look at here, these funds here, they are fully realized. So there is a direct connection between the DPI and the multiple, which is no surprise. The puzzling factors are here, for example, you have 159 plus 1, so that's 160. And apparently, for some reason, it's computed at 171. So there are some discrepancies in the data, but I don't know where it comes from because I don't have the details of Prequin's calculation and cash flows. And then, so this is the median performance. And what's interesting for us, for example, is to identify the borders between the first and the second quartile. This is here. So everything in 1990, which is above 245, is the top quartile. Then if you're below 245 and 192, you're the second quartile. If you're below 192 but above 138, you're in the third quartile. And if you're below 138, you're in the bottom quartile. Now you see something very interesting probably, is that sometimes you can be in the third quartile and still manage to do a great performance, like in 91. 91, the border between the third and the fourth quartile was a multiple of 2, right? The multiple of 2, which, for example, in some years, you don't even find at the border between the first and the second quartile. So when I said that the variation of performance from one vintage year to the other can be very significant, you have very clear examples here. Of course, in some years, you already lost money in the third quartile. And some years, it's only probably in the fourth quartile that you lost money. Then you have the IRR. The IRR is a little bit more complete in the sense that they provide us here with, of course, the same analysis. So it's in percentages, okay? With the top quartile, the second quartile was the border, then the median, and the other border, okay? And you see that here, when it's negative, it's probably related to the fact that you lost money, even though for some reason here, it appears as if you didn't lose money. So why? We have to be very careful. That's something I learned the hard way. When you see that a fund is in top quartile in IRR terms, it doesn't necessarily mean that it's in the top quartile in multiple terms. You can have a fund with a higher IRR and a low multiple, or you can have a fund with a high multiple and a low IRR. So it's not the same population. It's the same sample, of course. It's still 8 funds in 91, but as I said, the top quartile is not necessarily the same funds, the same 2 funds in the first quartile in terms of multiple and in the first quartile in terms of IRR. So it has a lot of consequences because it can lead us potentially to a lot of misinterpretation if we assume that the sample is constant. And to my knowledge today, no database provider offers you the opportunity to set, for example, in stone, the multiple quartiles and then to look at what is the distribution of the IRRs based on that. Unfortunately, not yet. Here, what's very interesting is that you have the max and the mean. So now you can say in 90, the top quartile is between 72% of IRR and 25. Then the second is 25 to 18. The third is 18 to 7, or let's say 8. And the bottom quartile is 8 to 2. So it means that in 1990, you couldn't have lost money, even though you selected the worst performer, okay? So that's how we read these tables. Of course, it's a bit frustrating because we don't have the details, etc. And also it depends on what's captured in the database. It's not necessarily fully reflective of a market at any given time. And we're fully aware of that. That's why in private equity, we're supposed to be very modest with our conclusions because we are very dependent on only a partial view of what's happening that's related to the data. But nevertheless, it helps you to understand the dynamics of the market, to see that, for example, sometimes you can lose all your money, even though we said yesterday that it's very, very unlikely with a fund. Okay, but here it happened. So I don't know what happened in 98 with this worst performer. But you see that otherwise, it's very coherent with the statistics I gave you yesterday, even though here you lost 50%. It's quite high, and here again. So there are differences from the, let's say, the overall big picture I showed you, but there, let's say, exceptions. Most of the things most of the data is coherent, which is around, let's say, a 30% loss ratio. So let's have a quick look now. I promised you that we would have a slide to understand. I'm just moving the chat window to discuss the different instruments. So this is the formula of the IRR. We have to be very careful about what we read in the news and what we read when we receive data. The first thing that we always have to remember is that there is a gross performance and a net performance. The gross performance is actually looking at what's happening in the underlying investment. So you don't integrate the cost of investing, management fees, carried interest. You bought this business, you sold it, and these are the two elements that you use to compute your IRR. we don't use gross. Most of the time, we just look at it because it's interesting, but we don't use it. That's all. Why? Because it's impossible to compare. Nobody has exactly the same cost structure, maybe the same structure of management fees, the same structure of carried interest. So if you want to benchmark a fund, it should be normally net, because that's the cash which goes back in the pocket of the fund investors. And still today, you will see that sometimes the communication from some actors is a little bit misleading, because implicitly they refer to gross without telling you, and you were thinking that. And then, of course, the difference is around 600, 700 basis points. So it's not negligible. When they say, oh, we will do an 18%, or we did an 18% IRR, and it's gross, it means that technically they did around 12 for the fund investors, okay? And they might argue, yeah, but that's our actual performance, the rest doesn't matter. It's, of course, a valid argument. The thing is that you still have to consider the fact that fund investors only get a share of that, okay? And so for them, the net is what matters, and that's why we should try as much as we can to communicate and talk about net performance. It's a little bit more intellectually honest, and then also it makes things more comparable, okay? So as I said, it's great because people think that they understand an IRR. If I tell you my performance is 12%, I'm sure that you understand what I mean. It means that if we consider on a yearly basis, theoretically, I should have given you 12% more than what you had at the beginning of the year. End of the story. The problem is, as I said, it assumes a reinvestment at no cost at the same level of performance. That's the implicit assumption in the IRR formula. The second thing is that the IRR doesn't tell you if you've been very good or if you were lucky to be at the right time on the right market. Said differently, sometimes you will see that IRRs are very high, and we saw it in the previous slide with some specific vintage years like 91, 93. The market was very supportive. Everybody was doing extremely well, whether in terms of IRR or in terms of multiple. And so that's quite crucial to keep this in mind, because sometimes people can show very high IRR, but then you realize the market conditions were very supportive. The third, and that's the explanation that we already have seen, is it's computed on the capital effectively used. So on the previous slide, I told you that we use mostly all the capital, but if we didn't, the fund investors might say it's a bit disingenuous, because you asked me to commit, I promised to pay 10, you effectively use 8, and you compute the performance on the 8, but the 2 that you never used, they might have cost me some money, just an opportunity cost. I could have done something with this 2 million. I was waiting for you to use it, and now you tell me that you don't want to use it, but this has a cost for me. And for some regulated investors like insurance groups, there is a solvency cost to the fact that you commit to a private equity fund. And even though the fund didn't use your capital, the regulator says you need to keep some of that as cash on your balance sheet for planning for some risks. So this, of course, is a bit complicated, because IRR cannot be computed on committed capital. It's a little bit the limit of the exercise. The other thing is that, and we will come back in the conclusion of this training session, is that the IRR can be manipulated by the use of equity bridge financing. And the reason for that is because it's so sensitive to timing. Let's take a quick example. Once again, I will come back to that in the section 5 in the Q&A of today. But I just want to illustrate that because it's very important. Earlier, we said the average duration of investment is around 3.5 years, let's say 4 in buyout, right? So the fund manager identifies an opportunity, the fund technically should call the capital, and this capital will be used to buy the company that the fund manager identified. Okay, and then after 4 years, the the investment is sold, and then the fund has a limited time, usually 10 days, maybe 30 days, to give back the money to the investors. Okay, that's the normal case, right? Now, imagine that the fund manager has a friend in an investment bank, and the fund manager says, all my investors are AAA institutions, sovereign wealth funds, pension funds. They will pay, no problem. They have the cash. They're very stable, very secure. They have the cash. But what I would like you to do, my friend, is to lend me the money for the investment that I'm about to do. And I would like to borrow, for example, this money for the next 12 months. Okay, so you will get repaid. I will pay you an interest on the money, but yeah, I will use your cash to buy the company. Why? Because then the IRR clock doesn't start. The IRR clock starts when you call the capital from the fund investors. So if you use a loan, then technically the IRR didn't start. And now if you use 12 months, it means that your duration of investment, instead of being 4 years, will be 3 years. And as we said, the IRR is very sensitive to the time exposure. So you can imagine, by compressing by a quarter your investment duration, then your IRR is going to increase dramatically. But we can even go one step further. After 3 years and a half, the fund manager says, look, you, my friend, investment banker, you lended me some money when I wanted to buy this company. And I thank you again for that. By the way, we paid you with interest and etc. as we planned. But now I'm planning to sell this company. And we are very advanced. There is an auction. We have good offers. It's going to take 6 months, but ultimately we should get between X and Y. What I would like you to do is to lend me again, not the full amount that I will receive, because I don't know how much it will be, but a portion of the amount. And ideally, this portion would be the amount of cash that my investors have put on the table to buy this company. And if you do that, then I can stop my IRR clock. Why? Because yesterday, as I said, and earlier today, the IRR starts when you call the capital, and it stops when you distribute the capital back to the investors. And then suddenly, instead of having a 4-year exposure, you have a 2 years and a half. So you reduce substantially the time during which the capital was at work. And that's going to push up your IRR very, very significantly. Why do fund managers do that? Well, one of the things we observed is that when you used to do buyout 40 years ago, you had very little competition. So because of that, the valuation of companies were lower. You could structure the operations in a very aggressive way, and your performances were very, very high. So your peer group was limited, your performance was exceptional. You had a very nice environment to execute. Then as the time goes by, buyout has been more successful, attracting more capital, more fund managers. The competition has intensified. So basically, the market is maturing. Asymmetries, lack of information are reduced. They still are significant, but they're reduced from the very early times, right? And the valuation of companies is increasing because the sellers have more potential buyers. And so the pressure on you as a fund manager is to continue to execute and generate high performance, but you get benchmarked with your competitors, and everybody suddenly is in an environment where the performance is more homogeneous, and of course, tendentially a little bit lower, because as the asymmetries and imperfections of information are reduced, then technically the risk decreases, and then the performance goes along with it, right? It's not just pure theory. There is an empirical background behind that. But the temptation is to say, but I'm still doing a great job as a fund manager, but unfortunately, my competitors do a great job too. And so sometimes it's the difference to get in the top 25% or just below is a very, very tiny increment of performance. And so if I could boost my IRR to be always in the top quartile, I would have an easier life when I need to raise my next fund in 2 to 3 years. And so the temptation to use credit line essentially comes from there. There is no actual operational logic to use that. There used to be one when people are in vacation or it's Christmas and you need to do an investment and you don't want to do a capital call because you know that it's going to be a nightmare. Then you use an equity bridge financing to wait January, February, or to wait September, October, and let it go. But if you borrow money for 12 months, it's obviously that you have another agenda in mind. And it could go to 24 months, maybe, why not? It depends on the regulations and IFMD, but basically, this is an environment where everybody is competing very, very strongly with everyone. The players are excellent at what they do. It's very difficult to push the performance up because everything conspires against you, the efficiencies, the competition. So then the temptation is to boost your performance by using credit line. And today, institutions such as the LPEA, International Limited Partners Association, but also Invest Europe and a few national associations have been explicitly saying that if you should always provide the IRR with the use of credit line and without, so that you can still enable the LPs, the fund investors, to benchmark your performance. And I think it makes a lot of sense. Of course, some investors love the fact that you use credit line because they use their capital somewhere else. Unregulated investors like endowments, which are university foundations, but also family offices, if you don't use their cash, they're going to put it somewhere else. So for them, it's great. But others don't really like it because they have this heavy costs. And if you don't use their capital, they're not very happy about it. But that's the difference between the investor pools and the different interests of every fund investor. The other thing which IRR is that it's very difficult to compare and analyze. That's why we need the vintage years. But even then, as I said, sometimes there is a bit of a slippery slope in attributing a fund to a vintage year, and then it's not risk adjusted. We look really poor when we compare ourselves with hedge funds and listed stocks, etc. They can produce these risk-adjusted performances like the Sharpe ratios or Kino ratios and all of that. And for us, it's like science fiction. As you will see in a moment, and when we will discuss risks in section 3, so just the next section, there is no easy way to measure risk in our world. We have multiple metrics of risk and they're still a work in progress. All this analysis about beta, for example, which is the volatility of prices, doesn't apply to us because volatility assumes tradability and we are not tradable, not on an open market. So correcting for volatility doesn't make any sense. When they talk to me about that, I said, well, we're not volatile, so you should put 100% of your money in private markets, right? We were not moving, so it's great. And they're very, very frustrated by that. So what are the alternatives? Well, as I mentioned, you could use the mirror, but the problem is that the mirror is very difficult to compare and it doesn't talk to us. It's a great tool statistically, but it's not empirically very easy to use. And as I said, you can play with the reinvestment rates to correct that. But the problem is if your peer group doesn't, or if the database provider doesn't provide you with this opportunity, it will just be comparing apples with oranges. So let's have a look. Oh, yeah, I was supposed to show you the example, but since I explained it, we can come back to that with the Excel if you want at the end. I was willing to show you a fund A and B with the so-so and the great investment, but I explained it verbally. Let's have a look at multiple. The multiple actually, it has a lot of advantages. The first thing is that it can give you an idea of what's effectively done versus what's estimated. We know that from the academic literature, and that's what we mentioned yesterday, that fund managers tend to be conservative when they value what's in their net asset value for a lot of reasons. The source of experience, the fact that they want to provide fund investors with a fairly good idea, but then conservative one. And the other thing is that they don't want to be caught later saying that they have overestimated the value of their portfolio. The other thing is that if you remember what we said yesterday, during the divestment period, the management fees are computed on the net asset value of the fund. And one of the things that the fund managers don't want to run into is to be accused that they inflated the NAV to collect more management fees. So there are a lot of motivations for them to be conservative with the NAV. And at least if there is any kind of manipulation of the residual value, it's on the conservative side, which I think is a positive feature, but it's just my opinion. And so here again, we can talk about gross and net multiple of invested capital. Sometimes you will hear about TVPI. TVPI and MOIC are exactly the same thing. As I said, we love sometimes to have multiple names for the same concept. So the great thing about this is that it's quite factual. And if you use a credit line, for example, it will reduce your performance because the MOIC or the TVPI will take into account the fact that you paid interest. And it's not sensitive to time. So actually, that's why you should always use IRR and TVPI combined, okay? Because both give you a source of information and they're very complementary on their perspective. So that's why I recommend to clients, never try to choose just one. Try to gather as much information as you can and then combine them and see what is the overall picture that you get from this combination. Now, what are the drawbacks? Well, besides the fact that it's difficult to understand for the rest of the world, this multiple, it doesn't take into account the impact of time. So if I tell you my multiple is, I don't know what it is at the moment because I'm finishing my report, but I would assume 1.6 or something like that. Then the next question you're going to tell me is, you're going to ask me is, how much time did you need to do this? Because it doesn't talk to you. It might be great, or it might be very, very mediocre. The second thing is, just like for the IRR, it's not computed, it's computed in an environment which can be very supportive. So if the tide lifts everyone, you would just go with the tide, and the multiple won't tell you if it's your performance or if it's the overall market performance which is going up. It's computed on the invested capital, even though you could compute a multiple of committed capital here if you want, but this specific metric is on the invested capital with all the problems associated with that. And then it's difficult to compare and it's not risk adjusted. Same criticism than for the IRR in that case. The public market equivalent solves some of the criticisms which are addressed to the IRR and the multiple, but it suffers from its own issues. The first advantage is that you could really compare apples with apples, and you can get out of the private market sector. You can compare yourself with the S&P, with the MSCI World, with the FTSE 100, the NASDAQ Composite, the DAX, the CAC, whatever. You can really use this, and to the point that technically, I've done it for a client, you can use any kind of index. As long as you have a data series and it's coherent and computed correctly, you could even benchmark private with private. For example, in the real estate world, you could be tempted to a certain extent to compare your private real estate strategy with the NACRAVE, which is an American index of the evolution of the value or the performance of private real estate. The problem with the NACRAVE is that it's gross of fees, so you have to be very careful. But the underlying assets are private, so you could compare private with private in that context, assuming you can solve the issues with the cost and the fees to compare net with net. But yeah, that's one option, for example. So it's great. It's great. It's a potential solution. The second thing is that suddenly you don't debate anymore about liquidity premium. That's something which I would have replied to the people who wrote for the CFA magazine. Look at the PME, and if you're right, and then your your leverage portfolio of small and mid caps in the US should have exactly the same PME than the private equity fund. Actually, it should have a higher PME because the private equity funds have heavy fees, which are reducing their performance, whereas your listed index, leverage index of small and mid caps doesn't have that. So their PME should be higher than for the reference pool of funds. And whenever I run this analysis, I used to publish a quarterly for clients, you would see that it doesn't hold. There is always an outperformance, a very significant outperformance from private equity funds versus an index of listed stocks. Of course, the index is not leveraged, but even if you apply the leverage, it would still show an outperformance. So it's not just leveraging up. And so the PME takes into account the context. If the CAC 40, which is the index of European, French listed companies, goes up, it will show in your PME. And then you can see how much your funds have been doing above this or below this, okay? So you can really assess what's the excess versus the index, apple to apple. Now, what are the problems? The problem is the index. Often you will see that in an ideal world, you would have an index of European startups, and then we don't have that. So what do? That's a big question. We don't have the NASDAQ in Europe. So if you want to benchmark European venture, you have to either build your own index, or then you need to play with what's available. The other thing is that sometimes the indexes are not sufficiently old in terms of timeline to be compared with the strategies. So if you go to the US, you're lucky because the NASDAQ exists for a long time. But even if you find a Euro Stocks index of fast growth companies, etc., for Europe, you might see that the index started fairly recently compared to how old European venture is and how far back the vintagers go. So that's a little bit tricky. And then I don't even talk about emerging markets. I used to give a lot of lectures and trainings in LATAM. And the problem of LATAM is that whatever is listed is either conglomerates or often in oil and gas, timber, banking, insurance groups, some of them, and then maybe retail. The problem is that most of these sectors are not targets for buyout, for example, and even less for venture. So when you benchmark yourself with the Colombian index, it doesn't deliver you a meaningful information, unfortunately. So that's a little bit problematic. It's sensitive to the choice of the index, but also sometimes you don't have a proper index. And that's why by default, we revert to the MSCI World, and then we get criticized for that. The second thing is that the PME is very sensitive to the fact that the fund is largely realized or fully realized. It's quite logical because what we said previously is that the residual value is actually estimated conservatively, right? And so if you keep this in mind and you run a PME, the index will go up as it happened over the course of the last 12 years now. And the fund NAV has always a big lag, actually. It's related to the fact that the information comes out, but also the fact that the NAV doesn't reflect the full potential of the portfolio until it's actually exited. And so the PME starts to get interesting when the action is finished. And that's a little bit of a problem. Even though the PME Plus and the modified PME, so the method of capital dynamics and the one from Cambridge Associates, try to somehow at least break down the problem and solve partially, but they cannot compensate the fact that we are very conservative when we assess the NAVs. And then it has the same problems and drawbacks than IR and multiple, because ultimately that's what we're going to produce through the PME, an IR and a multiple. Okay. I will make a pause here. Is there any question? We still have 40 minutes, but we are more than halfway through. Yes. So Lenka says, asks, so is the manipulation of the IR with credit lines a standard practice? Mm-hmm. Do you need investors' consent and opinion on this? So I can already answer the second one. No, you don't need, as long as it's written in the fund regulation. So what we call the limited partnership agreement, if it's a limited partnership, as long as the investors consented to it, you don't have to ask their consent after. So that's tricky then, because you already said yes, and we can use it at their discretion. We don't have statistics about how many, I mean, to my knowledge, maybe there is, but I didn't get access to that. How frequent fund managers use equity bridge financing, I don't know. I tried to look into that, but there is no source that I can really capture. There might be academic notes, but I didn't read them yet. It's a very, very difficult assessment to do, because what you would need, is either someone who tracks it from the lender side, so a kind of Fitch or S&P, but it's so specific. I'm not sure they would do that, and it's very difficult to assess. Or what you would have to do is identify the gap between the paid in and the actual investments of the fund. That would give you a net exposure of credit to credit lines, but it still doesn't tell you how often it's used by how many fund managers, because it's just a volume analysis. So that's the limit of our knowledge, I would say. More questions? Yes.
Thank you. No, that's it.
Thank you.
Understood.
So if there is no further questions, there will be a Q&A like we did yesterday at the end, but then I will continue. This is an example. So Cambridge used to provide some of this MPME, modified public market equivalent, for free. It's no longer the case. That's why I had to use an older table, but nevertheless, it's still very interesting. Their PME method, I'm not affiliated with Cambridge, but my opinion, personal opinion, is that it's the most advanced form of public market equivalent method, because it uses the NAV and it corrects a lot of distortions that we've been referring to earlier. And so here I took an interesting table that they published some time ago. I think it was mid-2017. And I wanted to illustrate how do we use that, and how we read it. Sorry about it. I want to change my pointer. Here you go. If you look at this table, you have, so it's an American firm. So what they call private equity is buyout and mezzanine, and what they call venture is what we called yesterday venture and growth. Okay, so it's actually out of the US, developed markets, so Western Europe, Australia, New Zealand, Japan. Private equity under the European definition, that's the performance on a 1-year time frame. Actually, I don't use the 1, 3, and 5 years because the funds are still active and it's essentially not relevant because we use conservative NAV. What I start to use is 10-year because here you have some realizations, but still a bit of active funds, a fair bit. So, but it's still very recent, so you can still start to try to assess what's going on. And then the 15, 20, 25 years are great because this is a very long time frame and largely dominated by liquidation. But the problem is that it reflects on the time which is very far out in the past and might not be representative of the current situation. Nevertheless, so I use the 10 to 25 years time frame. And now you see something very interesting. The performance here is very coherent. And it's an IRR here, calculated with the PME for the benchmarks, okay? And it's around, let's say, between 13 and 14% IRR. Now, what they did is that they use different indexes, like the MSCI Europe. They're also reconstructed indexes to provide some perspective, and I will explain to you why it's interesting to look at that. And then they are the MSCI EAFE. And so basically they bought and sold the index as the funds did, and they corrected the imbalances of the NAV with a regulation mechanism that they set up in their computation, which is quite well done. And so here you see that the range, if you use, for example, the MSCI Europe, knowing that Western Europe is 25% of the global market, and the rest, Australia, New Zealand, and Japan is a very, very tiny portion. So it's mostly Western Europe, and MSCI Europe is actually a good comparison. You will see that the difference is between 500 to 900 basis points. Of course, it would be easy to jump to conclusion and say, well, you know, private equity is great. We should all invest there. Look at the discrepancy of performance. But then comes the next thing. First of all, you will observe that the choice of the index might affect the analysis of the outperformance. So for example, that's why you should always try to do, if you use the PME, try to use multiple indexes, because some indexes outperform others, right? And so here we might be confused by assuming that the 882 basis points here are all attributable to private equity, but it's not, because if we look at their constructed index, it falls to 500 basis points. So out of the 882, there is 1/3 which might be related to the fact that there is underperformers in the MSCI Europe, for example, okay? So that's the first thing. The second thing is that some people might tell you, yeah, but if I buy the MSCI Europe, it takes me 5 minutes at worst. If I want to buy the market here, I need a lot of money and significant resources. So the question is, does this outperformance reward my effort and my risk? And that's another question, of course. But still, it's a very interesting perspective. I think you understand now. You can really compare, like for like, the performance of developed markets and an index, and you get the result here. Very interesting. And the MSCI World, of course, did a little bit worse than their constructed index, but that's why usually I try to use the MSCI World, and then, if possible, a regional one, and maybe a national one. And with these three, next to the private equity funds, you can really start to think, okay, is there any distortion related to the index? Or am I safe assuming that the indexes behave in the same way, and then the out or underperformance is more or less the result of the work of the fund manager, okay? I will just move the chat window back, okay. So I think we're done with the performance. We will jump into the risks and the costs. When I start to talk about risk, people get scared. They think that it's going to be very mathematical, it's going to be very theoretical and basically useless. What I try to do for clients is to do instruments which are visual first, not mathematical, also because I'm not a mathematician by training, and also because I know that the analysis of risk really depends on the type of client. So I would just provide you some perspectives. You can develop your own if you want, and I encourage you to do that. But it's just to show you how I try to think about it. If you talk to your colleagues in the listed markets, they would tell you that there are some risks which are pretty much standard across all asset classes. One is market risk, so movement of interest rates, foreign exchange rates, etc. And indeed, it affects us, at least buyout for interest rates and Forex. As soon as you have a reference currency, which might be one, and you invest in another one, then technically you are exposed to the foreign exchange risk and you cannot hedge it. Why? Well, the duration that I gave you earlier is just a statistical average, and it can vary a lot. That's the liquidity risk as we described it. The other thing is that hedging over 4 years, if you talk to your colleagues, they are going to tell you it's going to cost you quite a bit of money. Of course, you can optimize it, but eventually it will cost you money. And that's why most of investors in private market funds, they don't hedge. They just take the foreign exchange risk, and they hope that if they have a coherent perspective over time, it will blend because they have different asset classes, and they can hedge maybe the net exposure at their portfolio level instead of hedging it at every single level, underlying level. The second thing is that it's a sticky asset class. So instead of talking about liquidity risk as hedge funds would talk about it, we're talking more about the stickiness of the assets and the fact that we need to be committed for a certain amount of time. Once again, it's not really a liquidity risk. It's a different perspective. Then we have specific risks which affect us here. For example, when you have a capital call and you're short on cash, that's a commitment risk that doesn't really exist anywhere else, because when you're invested in a hedge fund, they call most of the capital in the first day. If it's not, it's within 6 months. And for us, we call the capital over 5 years, but you might need cash at a certain stage, and maybe you didn't plan your cash flows correctly. Now, if you default on a capital call, the sanction is usually very, very, very high. You might be kicked out of the fund. Your position in the fund might be reduced, and the reason for that is that you jeopardize everybody else's cash, because the fund might not be as diversified as it would have been. The fund manager cannot operate as it was planned, so you put a risk on everyone. And then besides that, there is a contagion risk. So the fact that one LP defaults affects everybody else. That's why the fund manager is so keen on solving the issue early, but there is a risk. And actually it happened a lot in 2008. You had, for example, Icelandic banks, which were, I think all of them were heavily invested in private markets, and all of them went into bankruptcy, to the point that actually Iceland had to be bailed out by the UK, essentially, if we make it short. And so the problem was, if you had a heavy representation of Icelandic banks in the fund you were in, then suddenly they stopped answering the phone. And then the problem was, what do we do? Should we reduce the fund size, or who is going to buy the stake of the Icelandic banks on the secondary market if there is not even anyone answering the phone? So that's a contagion risk. And then the portfolio could be jeopardized, basically. And then the main source of risk for us is probably the risk of losing your capital. And that's what I focus on for our clients. Instead of looking at, do we underperform or outperform, which I still do look at, the key question for clients is, am I losing cash and money? Or am I undershooting my performance threshold? That's much more relevant. Then the cost, we already talked about management fees and carried interest yesterday, but at the fund investor level, you have to set up your program, you have to run it, so that involves cost. And then there is, of course, the opportunity cost. What would have happened if I invested in Bitcoin instead of investing in private markets, for example? I'm not sure it's comparable and it's a good idea, but that might be the kind of analysis that some of your investors would do. And some of them do it systematically. They would never have invested in Bitcoin, but they still want to understand what would have happened if they had done it. And you know, that's a way to systematically put yourself under a scrutiny, and that's a good compliance exercise as well, I would assume, in many respects, at least in terms of risk analysis. And then there is, of course, the cost of the commitment itself, the fact that the cash is sitting on your bank account because it can be called within 10 to 30 days, and you cannot commit it, for example, to a money market fund, which offers you a redemption maybe every 3 months or every 6 months. So this is a graph that I like a lot. I did that for a series of clients some time ago, and it reuses some of the philosophy of what we saw yesterday with the graph with the blue bars, the green bars, and the yellow bars. What I did is that I said, look, we don't really have an S&P that we can put anywhere. What we can do is to look at all the fund of funds all together and say somehow they represent the evolution of the market. It's a bit of a simplification, but they're highly diversified. And if you have here, I think we had 600 funds I thought I put it somewhere. Ah, yeah, 489 funds. If we use this sample, then we would have a good market perspective, right? And so what I wanted to know is how often do we lose money and how much do we lose? And Cambridge Associates, which I use for that, offers you the opportunity to try to analyze that. Unfortunately, you can only run it with IR, not multiple, unless you know them very well and they would do it for you. But out of the database itself, you see that actually the chances to lose money, if you could buy the market, which is basically buying all this fund of funds, would be very, very little. And overall, you would have made money. It's an interesting perspective because it's really a kind of value at risk analysis to a certain extent. If you talk to a mathematician, it would tell you it's not true, but the reasoning behind is similar. It's what kind of risk do I take if I put my money in this market and I can do all the investments possible? That's a little bit the distribution. Okay, I think it's an interesting perspective because it's really what matters to investors. Loss of capital. Then we started to develop different tools. I'm just providing some to you, and it's just to feed your thinking. It's not to say that you should do that. Certainly not. I don't. That would be very pretentious from me. The first thing that I discuss often with clients is what I call somehow the macro risk, even though macro usually refers to GDP and all of that. But what I say is that what happens if I invest and I could buy the market, for example, in European buyout, okay? And so what we did is that we tried to look at the evolution over time and say, okay, worst case, we never lose money. If we could buy the market, we would never have lost money, at least from the funds which are fully realized. We didn't put the ones which are active because they're misleading. But it's very interesting to see that if you could buy the market, you wouldn't lose money. That's very, very, very interesting, I think. It's very unusual in finance. The second thing is that the variation of performance is very significant. So we started to refine this, for example, and say, how do we exclude outliers? Because if you put USVC on that, which I didn't put because it's very complicated to analyze in a short time frame. So I decided to use buyout. But what I usually say to clients is that I try to use two non-consecutive data points to say that then it creates a kind of rule. So here you could argue at this 298, top of my mind. Here it's not exactly 298. I hope you see my pointer. Maybe I should use the laser again. Then you could argue that you have some sort of rule, right? Because these two data points admittedly are very close and they're very far in the past and in unusual circumstances because of the Gulf War. But technically you could say that it could be the upper limit of your tunnel, right? And then the lower one, here again, it's a bit tricky because you just have 1 year in between, but it could define the lower bound, okay? And so your risk is the variation within this tunnel. And I might argue, how does it help me? I think it helps you to understand where do you stand and what is the variation you could model in your portfolio if you want to stress test it, okay? Of course, nobody can buy the whole market, but that's a starting point to start to then slice and dice your risk. The second step, and that's actually something that I use much more often, is what I call the extreme selection risk. So difference between top 5 and bottom 5%, and the most frequent selection risk. So the difference of performance between the top quartile and the bottom quartile. And here it's very interesting because you can also build these tunnels, and then you will see that it's very unusual that actually the bottom quartile loses money. This is the orange bar. It barely goes below 1. I think it's in 2004. It's shaving the 1, right? And then again in 2007. Of course, you might argue we would be interested to see the vintage years affected by the GFC. Yeah, but at that time, they were not mature enough to be included there. And so the most frequent selection risk is this dark tunnel. And you see that actually it's quite an interesting perspective because it's the maximum extent that you can get within a vintage year. And so here, I don't remember which one it is, but probably I would assume it's probably 90, or is it 2000? Yeah, it's 2003. That was the maximum range. This is interesting because it quantifies the risk that you take as a fund investor if you have like a very good skill set to select fund managers or not. Okay. The extreme one is more bad luck or good luck, right? You might end up at above 4, or you might end up with the bottom 5 losing a significant share of your capital. So these are another type of metrics. You could have also a reporting risk. You could have other risks that basically I didn't include today, but it's just to illustrate. Sorry, I'm playing with the chat window. I didn't want to switch the slide. I think the point of this is to try to make informed decisions. In an ideal world, you would accumulate the first and the second metric, but as you can see, the tunnels are not symmetrical and they can fluctuate a lot. And so it's very difficult to say you can have a macro risk and a selection risk because it's not fully coherent. You can have a volatility on the macro side and not too much on the selection side. Actually, more than often, if you look at the volatility, it comes from the top performers in the selection risk. The bottom quartile doesn't fluctuate that much. And actually, I wrote a paper about that. It was called Fishing at the Bottom. And I said, the bottom quartile sometimes is a very attractive proposition because if you don't lose money, you don't have the restriction to access. And the fund managers are very keen to get you. Then it might be a good perspective if you're not after absolute performance. Let's move on. I'm still conscious of the time. We are almost there. So benchmarking. I wanted to go very, very briefly into data, and I have no, let's say, whatsoever interest to sell you anything. I don't work for a database provider. I'm here just to clarify a few things. The first thing that you have to remember, excuse me, is that there are two different kinds of sources. There is a source which is bottom up. This is Preqin, PitchBook, CB Insight. They collect data which is available publicly, and then they aggregate it and offer it to you. And then you have a more top-down perspective. So Cambridge, Burgess, Pevara, they have clients investing in the asset class and ask them the permission to retrieve the data and aggregate it, anonymize it, and provide it to the market. Both approaches have their pros and cons. The problem of the bottom up is the quality, which is never guaranteed because you cannot go to the source. And if you find a problem, you cannot really solve it by yourself. The advantage is that it can be very granular. You can go down to the fund level, you know, which fund did what, and you can even go to the individual cash flows potentially. The top-down quality is much higher because this is the actual data which is in the back office of the clients. Of course, the clients can make mistakes, but it's very unusual. And usually most of these operators cross-check and they go back to the source if there is a problem and they ask questions. The problem is that the granularity is limited. If they don't have 6 or 8 funds in a sample, they don't provide you with the data. That's as simple as that. And you could see that here. When you have a dotted line here, it's because I didn't have the data for 91 and for 89. So not enough data in sample, no sample, end of the story. And it's even worse when you want to slice and dice the top and the bottom quartile. Here I have some data points, but not successive. I could not draw. And that's, of course, limiting the analysis. But it's high quality. So there is an arbitrage between quality and access to data, basically. Yeah, beyond that, I think that's it on the data sources. I want to keep enough time for the Q&A today. So I will jump into the current debate. So we talked about the credit lines And so what I wanted to explain, of course, is the fact that there are pros and cons of the use of credit lines. Earlier, I referred to the 12 months. It's not written anywhere, but you will see that some fund managers use credit lines for less than 12 months up to it, and others can go even above 12 months. The question is, how is it qualified under IFMD? The Alternative Investment Fund Manager Directive says, if you're a leverage fund, and that's of course theoretically addressing hedge funds, then you're subject to more regulations than if you're not. And my understanding, but honestly, I'm not a lawyer, is that you are declared as a leverage fund when you're using regularly this kind of instrument for more than 12 months, which is why I assume a lot of fund managers use it for less than that, because we don't want to be qualified as leverage funds. So as I wrote here, I really strongly advise that we look at the performance with and without, so that people know exactly what we're referring to, and transparency here is actually quite important. The other, I had the cost of unused capital. For some reason, the slide, I forgot to put it there. The cost of unused capital, basically, it would have been 3 lines. It refers to this idea that fund investors always are a little bit in a strange situation, because the actual cost at their level is also the capital which was not used by the fund manager. And that's really true for financial institutions which are regulated. And I think we need to be sensitive to that. Often when we say this is the net performance and there is nothing to think about, well, investors might differ. And that's related to the use of credit lines, but that's also related to the fact that sometimes we say, oh yeah, well, we didn't use the full amount. It's okay, the performance is excellent anyway. And then the fund investor in front of you might have a little voice in his head saying, well, it's not okay because it costs me a lot in terms of solvency ratios, for example. Now I should stop talking now and open for questions. We have 10 minutes. So yesterday I was a bit late. Today we are really perfectly on time.
Any questions so far? Don't be shy.
There is no bad question. And usually when someone has a question and says, oh, I wouldn't dare asking, probably half of the people around have the same. So the question is, who will take, the courage just to drop a line or to open the microphone? No? So
Hi, Cyril.
Yes.
Sorry.
Mm-hmm.
Just a quick question on the last topic, actually, in regards to credit line. Could it possibly have a positive effect on the returns in current environment? Sometimes we can see interest being even negative or close to zero.
So in theory, yes. In practice, no. It's a very good point, actually. In credit lines, you wouldn't find anyone lending you at a negative interest rate. I know that in real estate, in some regions, it's possible, which is very puzzling, but why not? If you have an excess of capital as a bank and you don't want really to charge your clients negative interest rate, then you can technically just pass on. But in that context, this kind of credit line here wouldn't be done at a negative interest rate or at a zero. So it's going to be at an interest rate. And so from this point on, then I don't see it producing performance. I've never heard anyone building the case saying, we use a credit line, it was the best choice ever, it enhanced our performance, besides the IR, significantly. But I'm not saying that it's always bad, certainly not. And as I said earlier, sometimes it's a bridge, which is very welcome. Sometimes we do. Summer is typically the case where you have suddenly a boom of deals, because I don't know why it happened so many times for me that, you know, August was actually very busy, even though I thought at the beginning I would be very, very quiet. And then you cannot call capital. Everybody's at the beach or relaxing. You don't want to put pressure on your investors. Then you use an equity bridge. Just, you know, waiting September, October, catching up, and then doing your capital call. So in that sense, it's not very expensive, and it's a very good tool. What I'm a little bit more reserved about is the overuse for extended period of time. But thank you for the question.
Yeah, thanks for the answers. We appreciate it.
More questions? Otherwise, it's more than a Swiss timing. It's a Luxembourg time, right? We're even early on the clock.
It seems that you have covered everything so far.
Excellent. Then tomorrow we will continue. We can also do a Q&A as Evie suggested today, and I think it's a good idea before and after instead of just after. Yeah, I mean, sometimes, you know, during the night you wake up and you're, oh my God, I forgot to ask a question, and then next time. And so tomorrow at 12:30 you have the chance. Okay.
Thank you, everyone.
I wish you a very good afternoon, and see you tomorrow. Thanks again. Bye-bye.
Thank you, Cyril. Thank you all. Have a nice afternoon.
Thanks, bye.
Bye bye.